Listen-only mode.
Good afternoon, ladies and gents. Before we kick off the webinar, if you could please raise your digital hands just to see if you can all hear me clearly, and then we will take it from there. I'm seeing quite a few digital hands up in the air, so I think we will begin. All right, it seems like everyone is hearing us clearly. Please, if there are any questions or if there are any problems with audio connection, etc., please don't hesitate to ask a question. My name is Chris Rule, and I'm from Corshares. Before I kick off, I'd just like to thank you all for joining us today for what will hopefully be an interesting webinar. And I would also like to thank the team from Standard Bank Online for extending invites to you all, and of course, once again, for hosting us on a webinar. So, as I said, I represent Corshares, which is an ETF business. We have a number of ETFs on the JSE, and of course, all of those ETFs qualify for tax-free savings accounts. So that's why we're going to be chatting about tax-free. If you have any questions, please drop them in the inbox. I'll either take them at the point in time in the webinar if it's relevant, or we'll wait until the end and then we'll field all the questions. So as you know, there's no such thing as a stupid question. So please just drop any questions you have in the question box. So today we're going to be chatting about tax-free savings accounts. And really we're just going to be chatting about some of the benefits of tax-free savings accounts, which kind of products qualify for tax-free savings accounts, just a few red herrings or a few things to be aware of when you're investing in tax-free. We quite often see clients making mistakes in terms of tax-free savings accounts. So we just thought we'd give you a couple of what we see as common errors when making investments into tax-free savings accounts. So we're talking about tax-free savings accounts as this relatively new investment vehicle, but in fact it's well into its it's had already 2 years of track record, and we're well into the third year of tax-free savings accounts. So hopefully you've all been contributing. If you haven't, the time is now. They became effective on 1 March 2015, and effectively it was a drive from the government to try and improve savings, or to try and encourage more of a savings culture in our local market. So what it means effectively is that you can save up to 33,000 Rand a year, and a total 500,000 Rand contribution in a lifetime. And all investment returns on those investments in the tax-free savings vehicle will be tax exempt. So that's dividends, which is at 20% for individuals, interest, which is depending on your marginal tax rate, could be as high as 41%, and capital gains, which of course can also be depending on your marginal income tax rate, but can become quite cumbersome in an investment return. Really, a fantastic opportunity allowed to us by government to be able to save tax-free, which is very unusual. So something that we really should be taking into account, or should be using. So there are a few kind of things to look out for, and there are a few dates and important numbers to remember before you are allocate to your tax-free savings account. So the first is you have an annual limit of 33,000 Rand. That's per natural person. So you can contribute on behalf of your children, etc. But effectively, it's 33,000 Rand a year per natural person can be contributed. No more can be contributed in that. So there's one important thing to note, that if you withdraw from that contribution, that will still be counted as a gross. It's a gross contribution, it's not a net contribution. So just a quick example to give you an idea of what that means is that, let's say from 1 March, because the tax year runs up until the end of February, or 28 February, if you contribute 33,000 Rand from 1 March until the end of December, and then you go and withdraw another 7,000 Rand of that tax-free savings account, then you aren't in fact able to contribute that 7,000 Rand back in before the end of the tax year. It's all on gross contribution, so it's not a net contribution basis. And really what that means is something from a mind shift or from a mindset perspective as an investor, is that you really should have a long-term view when you're investing in tax-free savings accounts. And the reason is because you are limited in terms of your gross annual contributions, but also your gross total contribution of 500,000 Rand. So once you've made those contributions, then that is the total. It's not on a net contribution basis. So we often see clients or investors who are investing in a tax-free savings vehicle or in a tax-free savings account, and they're doing it over 2 years, and they're drawing the money out for whatever goal they have. In terms of trying to maximize the potential of your tax-free savings account, you really should have a long-term mindset when making these allocations. And if there's anything that's shorter term, perhaps we should consider making those investment decisions outside of a tax-free savings account, and rather keeping that tax-free savings account for long-term investments. Also, what some people are not aware of is there are a number of tax exemptions available to individuals. So interest exemption is the first one. In other words, you are tax-free in those exemptions as it stands. So for individuals, the interest exemption is 23,800 Rand. Now that means that if you were earning, let's say, 5% interest, you would need a total capital amount of about 480,000 Rand, that exceeds 480,000 Rand to actually fall outside of that exemption. Of course, as the interest rate goes higher, then the capital amount comes lower. But the point is that if you were looking to invest, let's say for a 2-year goal, and you're going to be sitting mostly in cash and earning interest, well, then you have to ask yourself, are you going to be earning over and above that already existing or the pre-existing exemption? And if you're not, then it would be foolish to use your tax-free allowance, because as I said, it's a gross contribution, not a net contribution. So if you were going to draw that money out, well, then you've used some of your lifetime contribution. So we would rather encourage a long-term investment philosophy in that instance. And the second is that if you're retired or if you're over 65, the interest exemption, of course, moves up from that. So that moves to about 34,500. So 34,500 would relate to amounts of slightly higher, probably closer to 700,000 Rand. So these are quite large capital sums of cash where you're actually exempt of any tax in any instance. So please consider your own tax exemptions that already exist before you invest. And the other is that you have a capital gains exemption of 40,000 Rand a year as an individual. So that's of your capital gain. Let's say you make 100,000 Rand in investment, and your total gain is 40,000 Rand, or less, let's say it's 30,000 Rand, so total investment is 130,000 Rand. Annually, you have an exemption of 40,000 Rand, which means the total capital gain there would be, in fact, tax exempt. So there are some exemptions already within SARS and National Treasury that they allow you to invest effectively tax-free. Got a question. The first question, and this is relevant, as I said, I'll take questions which are relevant. The first one says, I thought the limit was 30,000 Rand a year. Why 33,000 Rand a year? When has this changed? So in terms of the budget speech of February this year, the change of the annual limit was up to 33,000 Rand from 30. So you're quite correct. When tax-free savings accounts were brought into legislation, it was 30,000 Rand a year. It's now 33,000 Rand a year. What hasn't changed is the annual lifetime limit. So that 500,000 Rand limit hasn't changed. All it means as an investor is that you'll just reach that limit much quicker. Well, not much quicker, but about 10% quicker. So, in terms of at 33,000 Rand a year, you would reach your limit in about 15 years of contributions. So that has changed. And it's important to be aware of these changes, because you, of course, can contribute an additional 3,000 Rand a year. So moving on, this is just to highlight that there are important exemptions which are available to you in terms of interest and capital gains. Of course, as individuals, dividends withholding tax is compulsory or mandatory. So in other words, there are no exemptions available to you. So you will always pay dividend withholding tax. So why tax-free? Why would you invest in tax-free rather than just in your personal capacity? And it's pretty simple. It's an opportunity for investors to make long-term investments or save in a more efficient way. The intention from National Treasury was to try and encourage investors to save for long-term goals. And then, of course, it's one opportunity to try and secure your future financial security. And of course, no one likes paying tax, so that's a given. That it's a fantastic opportunity to make investments in a tax-free environment, and that is a fantastic opportunity for any investors. We've got a few questions coming through. A question says, does that mean I can earn 23,000 Rand in normal savings and on top of that another 33,000 Rand in tax-free savings accounts? No. So I think where you've misunderstood me in that question is the exemption of 23,000 Rand is around interest earned. It's not around contributions. So that means that when you're submitting your tax on an annual basis, if you have earned interest, you would generally need to pay the tax on that interest based on your marginal tax rate. However, your first 23,800 Rand of interest earned as an investor is tax exempt, so you actually don't pay tax on that. So don't confuse the two. It's not, you can't contribute 33,000 Rand and then 22,000 over. It's an exemption based on interest that's already earned. Another question, and I'm going to field these questions now because they are relevant for this point in time. There's a question that says, can I buy back for previous years? I'm not 100% sure what exactly you mean here, but I think you mean, can you look retrospectively and say, oh, in 2015 I never contributed, so this year I'd like to contribute 66,000 Rand because I didn't contribute? The short answer is no. You can only contribute in a given tax year, and you can only contribute to the maximum limit of 33,000 Rand a year. So if you, in other words, if you hadn't contributed in previous tax years, you can't actually make up for that now by over contributing in this year. So it's important to contribute at a point in time when you're in the exact tax year. We've got quite a few questions coming around some of these technicalities. So I'm just going to pause here and take those questions while we're dealing with it. The question is, will you be penalized if you invest, say, the 2016 tax year amount in the 2017 tax year period? And what are the penalties, i.e. is it worth it? If I ask this because of financial constraints of putting in your full allowance. Okay, again, so that the same, I'm going to give you the same response as previous. You can only contribute the maximum allowance within the tax year. So unfortunately, if you didn't have the discretionary money available in the tax year, so if you don't have the 33,000 Rand available to invest for, let's say now we're in the 2017 tax year, you can't contribute it the following year. You have to contribute it in the tax year that you are dealing with. So I think I've dealt with all the questions that relate to some of the technicalities. So that's why I was talking about gross contributions, not net contributions. So there's a question about can someone buy back and put money back in? And no, you can't. So once you tap on the 33,000 Rand annual gross contributions into a tax-free savings account, you cannot contribute anything further. So if you then go and draw money out, it's not on a net contribution basis, it's on a gross contribution basis. So I am harping on that, but it's a very important consideration, and we're getting a lot of questions around that. So I just want to make that clear. There's also a fantastic website called taxfreesavings.co.za. Save tax-free, apologies.co.za. So please, if there's any confusion, go there. They've got a lot of answers for you, a lot of different scenarios. What can you invest in within your tax-free savings account? That's the important question, I suppose, as an investor. And in terms of National Treasury, when they put together legislation around tax-free savings, they put together a number of criteria of products and which products qualified for tax-free savings accounts. So tax-free savings products must have the 3 criteria. They must be simple, they must be transparent, and they must be suitable. I mean, this may sound obvious, but they must be simple in terms of the underlying assets, and in terms of the underlying returns. In other words, they're not performance fees, they're not significant derivative overlays, there's not hedge fund exposure. Typically, they're very simple investment or savings products. The second is they must be transparent, so there must be clear disclosures on the costs and all the fees involved. Of course, because the product is tax-free doesn't mean it is free of any management fees or costs or charges around the product that the product provider would charge. So one of the things is that those fees must be clear. So one of the important things that National Treasury said is there are no performance fees in tax-free savings accounts. And this actually shook up the investment market quite a bit, because some of our higher cost active competitors only had performance fee related unit trusts. So in fact, those guys had to go out and launch unit trusts without performance fees. And they must be suitable. So the investment must be suitable for the investor. There must be a needs analysis. You must understand what kind of returns that you're trying to achieve, and must be the product based on that. So who are these products? What are these products, and who are the eligible providers? The first are, and probably the most well-known, which is a little bit concerning to us and to a lot of the investment community, is interest-bearing accounts. So banks often market their tax-free savings accounts for investors who can put in 33,000 Rand a year and earn fantastic tax-free interest on that account. And I'm going to tell you why it's concerning for a lot of investors, because unless you have more than 500,000 Rand, then this interest exemption would give you a tax-free investment in any case. So if you have less than 500,000 Rand earning interest, or approximately 500,000 Rand, it depends on what interest rate you earn, then investing in a tax-free savings account is actually pointless, because you already have that opportunity to get the interest exemptions. If you, of course, have more than that in cash, then yes, the interest-bearing accounts does make a lot of sense, and it makes a lot of sense because your marginal tax rate would be high, and you would be getting tax-free investments or returns on that. So that's the first, and probably the most commonly known is the interest-bearing accounts. The second is exchange-traded funds, collective investment schemes. So these are investment portfolios offered by asset managers like Corshares and stockbrokers in terms of managed portfolios. This is a very commonly used vehicle for tax-free savings accounts, and we will chat a bit about ETFs in a short. But these exchange-traded funds are collective investment schemes, and so they all qualify for tax-free savings accounts, with a few exceptions. And those exceptions are quite simply more commodity-based exchange-traded funds. So like the gold and the platinum and the palladium ETFs, those actually don't. And then the third is insurance products. These would be policies written by insurance companies, which may either give you a return like an interest kind of return, so 8% a year over the next 10 years, or they would be linking you exposure to an underlying asset class. So all of these products actually qualify. So we think that exchange-traded funds, especially for the online market, the Standard Bank online community, are a fantastic product for the tax-free savings account. And this is for a number of reasons. Of course, there's all the research and all the findings that, exchange-traded funds and passive investments tend to outperform active investments over long periods of time. So some 80% of professional asset managers actually underperform indexes which these track over long periods of times. So they're fantastic from that perspective. Secondly, in terms of ticking all the criteria of the tax-free savings accounts, of being transparent, of being simple, and of being suitable, they're probably the most well-suited in terms of hitting all the criteria. So they are transparent, they're extremely simple, and they're suitable. ETFs generally offer you the highly diverse products in terms of making an investment, and of course are highly regulated. So that's fantastic. But one really important consideration, and we want to just highlight something before we take a whole lot of questions on this tax-free savings stuff, is the cost effectiveness. So not only are you getting fantastic, efficient investing through a tax-free savings account, but because of the low-cost structures of most exchange-traded funds, you are additionally compounding on the cost saving. And this is we're going to bring up a graph now, which is quite a commonly seen graph, but it just highlights the importance over long investment periods of how much you actually can save through compounded cost saving in a tax-free savings account. This, of course, is amplified by the fact that it's a tax-free return. So all of the capital gains here are tax-free. All of the interest or dividends earned are tax-free. So this is just over 15 years. Let's assume we have an investment of 100,000 Rand today, and over 15 years we simply hold it, and the return is 14%. Over 30 years, apologies, the return is 14%. And there's just a simple difference of 1% in the costs, but they both achieve exactly the same return. So just to give you an idea, this would mean you would have to be right in the top end of active asset managers in terms of selecting unit trusts. So it's not just the average unit trust return, which is typically lower than the index, right up at the top, in the top quartile. But then you've got the guaranteed 1% outperformance. And you'll see there's a massive impact on your end investment of around R1 million. If you just reinvest your income and you invest over long term. So that's it from us. We as per usual, we like to keep the webinars quite short, around 20 minutes, and then we encourage all engagement with the investors now, so that we can go through all the questions that we have. So I'm going to start. We've got a few more questions. I'm going to go through these questions now. If you have any, please shout. Otherwise, thanks very much for joining us. And I'll be taking the questions now. The question is, as long as you don't exceed your 33,000 Rand, you can buy and sell within a tax year. I'm not entirely sure what the question is here, but I think you're correct. If I understand your question correctly, once you've contributed 33,000 Rand within your tax-free savings account and you want to move from one ETF to another ETF, that is admissible in terms of the tax-free savings legislation, in terms of the capital gains efficiency or exemption. It depends on your service provider, though. Some service providers don't actually give you the ability to swap between products. That is coming. So one of the things is even swapping between service providers is something that's being worked on at the moment. But remember, it's 33,000 Rand in totality per natural investor, not 33,000 Rand per tax-free savings account. So as an individual, you can't go and open up 5 different tax-free savings accounts and contribute 33,000 Rand to each of them. It's actually a total contribution. And that is as simple as possible. So yeah, I think you clarified saying keeping it within your tax-free savings account, can you move between positions? And yes, you can. Again, depending on your service provider. Okay, got some more questions. Can I suggest a Rand hedge ETF? Corshares, we have 2 what we would call pure Rand hedge ETFs. One is an S&P 500 ETF tracker. That gives you dollar exposure and exposure to the underlying market. It qualifies as a tax-free savings account. We also have a global property ETF, which is a Rand hedge product, and then that gives you global property exposure, but also hard currency. So when the Rand gets weak, then your performance will improve. But there's a number of global ETFs available to you. Quite literally, a whole lot of options. So do your homework and go look at the other options. Corshares, we only have 2. Of course, you mustn't forget that just within, for example, our top 50, there's a lot of Rand hedge stocks within it. Naspers, Richmond, British American Tobacco, a lot of our mining stocks are actually rand hedge stocks. So in our natural market in JSE, we get a lot of rand hedge stocks. But absolutely, for pure rand hedges, they do exist. I've got a question here. Can I open a tax? I'm assuming you're saying a tax-free investment account for more than 3 people and contribute to them. Example, if I have an account, can I open accounts for my wife, me, and for my kid? Okay, so yes, you can open accounts for your wife or your kids, as many kids as you have, as long as they're a natural person, and your wife. Of course, the only thing you would need to consider as an individual, that there is a donations tax limit per year in terms of donating to children, and that would be 100,000 Rand a year per person. Interspousal donations are completely tax-free, depending. Okay, I'm going to disclaim all of these tax things, and please seek out some tax advice. But depending on how you're married and in what legal form, in or out of community of marriage, but typically interspousal donations are completely tax-free. What that means is between you and your wife, you can actually donate 200,000 Rand to your children tax-free, and they can invest that into a tax-free savings account. So you do have that opportunity, which means you can actually have quite a number of children, let's say 5 children, before you start running into donation tax problems. So as an individual, what would be smart is if you, let's say you had 4 children, you could donate into each of those kids' tax-free savings accounts up to the 33,000, which would take you to 99. Then you would simply transfer the other 33,000 of your 4th kid to your wife, and she would do the donation to the other children. So there's a lot of opportunities, and there's some smart estate planning and tax planning you can do just by using some simple exemptions, which are already in the tax allowance. Remember, the stuff is not tax avoidance; it's simply available to you for questions. Why does the cost of the same exact ETF differ hugely between companies? Signia versus Satrix versus Corshares. It simply comes down to product provider. This is the same in any other industries. I'm not sure why people find it so unusual in the asset management industry that costs vary between various product providers. Just like banking fees, whether you go from Capitec to FNB to Investec, you're going to get very different fees. You might get different services, so just watch out for that. You might actually be getting different products. You should be comparing fees only when it's a pure like-for-like basis. So, in other words, if you're comparing Satrix's top 40 to Signia's top 40 to whoever else's top 40, that's fair enough. But if you then compare it to our top 50, you need to understand the product differences. Like, we have an extra 10 shares. We cap our largest single stock exposure at 10%. So Naspers, which is 20% of the top 40, is limited. So the fees do vary between product providers. Some of the reasons are simply at the point in time when the product provider launched a product, they've actually launched the cheapest product, and other products have come further down the line. So, it's not always a complex explanation. It's often quite a simple explanation. So, like any industry, fees will vary. So you've got to keep an eye out for that kind of stuff. Okay, so we've got someone's rephrased the question. The question is, through a normal savings account, the first 23,000 Rand interest is tax-free. Then I can put an additional amount of 33,000 Rand into a tax-free savings account, and that interest is also tax-free. Correct. So that's exactly. So remember, in a tax-free savings account, anything earned, interest, dividends, capital gains, is always tax-free. So it doesn't matter what the rest of your personal circumstances are. If you're getting marginally taxed at 43% elsewhere, it's irrelevant. That tax-free savings account is completely tax-exempt. So my point of highlighting the interest exemption was to say that you should be clever about how you use some of these exemptions. For example, if you are an individual, you will always get the exemption on the 20% dividend withholding tax. So if you invest into, let's say, general equities, you would be taxed ordinarily at 20%, regardless of your circumstance. There are no exemptions. So you get that 20% benefit immediately if you go into a tax-free savings account. Now, as an individual, you have to be smart about your tax planning. If you're sitting in the 43% marginal tax bracket and you were going to be earning interest and getting charged 43% on that effective interest earnings, then yes, maybe it makes sense to go into interest because that's the biggest tax shield relative to 20% dividends withholding tax. But if you actually had an exemption there, then you should be investing that interest elsewhere. There's a question, do you get the same amount of shares? I'm not exactly sure what that means, so please, if you can clarify that. Can I switch investment in tax-free account from cash to ETF or vice versa? So within a tax-free savings account issued by different product providers, and I'm going to hesitate to give you an outright answer here. There are different rules depending on whoever your product provider is. So you also need to be careful between the product provider. Some product providers may allow you to switch between different investment products, go from a unit trust into, I don't know, an ETF or a more cash type money market investment. Others may not. So just be careful about your product provider. Standard Bank has a tax-free savings account. I'm not entirely sure or clued up on exactly what the rules are there. Perhaps someone from Standard Bank online can chime in and let us know what the exact rules are. But certainly, in terms of what I've seen is that if you are invested in one ETF, to then switch into another ETF is not a problem, especially through like Standard Bank online savings accounts. So there we go. Does online share trading allow it? So either one of the, as I said, I represent Corshares, which is not related to Standard Bank Online. So I don't know the exact details of that exact portfolio, but if Lindsay or anyone from that team would like to chime in, they're more than welcome. Otherwise, they can take it offline with you and please send you an email. I'll let them know exactly who asked the question so that they can get in touch with you and give you all the rules. It seems like we've exhausted all our questions. We're happy to hang on the line for a couple minutes, and if there are any more questions, please fire away. We've got more specific questions around the Standard Bank online share trading functionality. Yes, you do. It is a separate account. They are completely separated from your other investments. So you're quite right in terms of your comments. And where your cash would sit in terms of the JSET account, that is correct. You just need to, I'll ask the Standard Bank online guys to get in touch with you just to give you all the rules. I don't want to speak out of turn, so apologies. So the first question is, when tax-free savings accounts, they were only interest-bearing accounts, I would like to be able to move this to an ETF. Guys, in theory, all of this is possible. There's nothing in the tax-free legislation that says you can't change from a cash investment to an ETF investment or to a unit trust investment or to an insurance product for that matter. Again, it boils down to your service provider and what they can provide. In this instance, we aren't the service provider, so please reach out to them. They'll give you a lot more clarity on that. Got a question here that says most of the products offered by Standard Bank OST for these TFSAs give poor returns. Can you recommend a product that gives more than 6% return? Okay, the first thing is returns. Once you move out of the fixed income or the interest-bearing account world, returns are not guaranteed. You're getting returns from the underlying markets. Typically, what we would expect from the South African equity market and why I keep highlighting over long periods of time is because the returns are variable through time, so you need to have a long investment horizon, 5 to 10 years, even longer. So equities would typically give you a total return of around 13%, even higher on average historically. So if you invest for long periods of time, you could typically get 13% from equities. So you could invest in a simple top 50 ETF to improve your returns. But you must understand that that's a long-term investment in nature. So you can improve more than 6% a year, but you need to be able to have a long-term view. What is the performance of a tax-free account versus normal long-term deposit? So, as I said earlier, if your investment means that the interest that you earn is not greater than the 23,000 Rand exemption, then your return in a tax-free savings account and in a normal deposit, assuming the interest you're earning is identical, will be identical. And they'll be identical because you're not paying tax in either instance. If it exceeds it, then your return will be exactly better by the tax that you would have paid on your normal tax-free savings account. So the underlying instruments, the underlying investments in tax-free savings accounts are identical to the underlying investments that you would usually have in your normal discretionary name. So I just want to make that crystal clear. In a tax-free savings account wrap, it's not some secret source or some special instruments that are trading in there. They're the exact same investment products which you would normally buy. They're simply tax-free. And that tax difference is going to be effectively the difference in your returns between the two. There's a question around penalties if you exceed the cap. I just want to clarify, I've got a colleague sitting in the room with me who's more of an expert on these penalties, but I'll get back to you. There is a penalty. I stand to be corrected, but the penalty is quite significant if you contribute over and above your tax-free savings account. And this is up to you as an individual to make sure that you do not be in excess. There we go. Just 1 second. So if you exceed your limit, your annual 33,000 Rand limit, then the penalty will be 40% of the excess amount that you exceed. So let's say you exceed your annual limit of 33,000 Rand and you actually contribute 43,000 Rand, you're actually going to pay an amount of 40% of that additional 10,000 Rand. So you're going to pay a penalty of 4,000 Rand. So it's extremely strict penalty, so be very careful when doing that. There's another question saying, should one wait for a dip in price before buying? That's the age-old question. We believe in investing, like putting in a debit order or making more consistent allocations to an investment. We don't think that individuals or institutions or professional money managers have ever proven to be able to time investing and investing cycles. So in other words, buy low and sell high, that kind of motto. We don't think that exists. Empirically, no one has ever proven to be able to time investment markets. So should you wait for the dip in price? Well, that's your personal preference. I personally think the best way to go about some of these things is just to make consistent investments. So invest exactly 2,750 Rand a month. Every month, and then you will hit your 33,000 Rand limit on the nose, and do that consistently. That way you'll be buying sometimes when prices are low. Of course, you'll also be buying sometimes when prices are high. But you get price averaging, which means you take a lot of timing risk out of allocating to an investment. There's a question here saying, do we provide access to an Aussie ETF or an Indie ETF? We don't have an Indie ETF. There's an Indie ETF that's run by Satrix. Before you invest in the Indie ETF, and I'm not having a dig at Satrix, I'm actually having a go at the index. Just be warned, there's a massive single stock exposure in that ETF. Fortunately, that's been a fantastic performer because that single stock exposure happens to be nice for us. But just go and have a look. Do just a common sense check of what's in the ETF. and make sure that you're not exposed to any individual shares highly. Of course, you're taking a massive sector bet. In other words, you're not just buying the market, you're buying a specific sector within the market. So that's something that you also have to be comfortable. But otherwise, the actual ETF that tracks the index is good exposure to get that exposure. So as I say, I'm not having a go at the Satrix ETF per se. It's a good ETF and it gives you good exposure. Just be careful of what you're buying. We don't have an Aussie ETF. There is no Aussie ETF in the market. We have an ETF which is a top 50 ETF, so the 50 largest companies. To give you an idea, that gives you 90% of the effective all-share exposure. So that means you're getting a large portion of that Aussie return. And the one difference about that ETF is it caps the largest single stock exposure at 10%. So in other words, your exposure to Naspers, which in the Aussie is around 20%, would be brought down to 10%, and that would be allocated across the next shares. There's a once-off investment approach, buying once-off versus per month. Would there be a cost difference in trading differences, doing it once-off or doing installments? So that depends on your platform. In terms of how we deal with our investments, there's no difference if you invest once-off or monthly. So you're not penalized for making smaller contributions. But certainly some investments have minimum brokerages, etc., where it would probably be more efficient to invest once-off. So take your 33,000 Rand a year and invest it. But again, some of these things are very product specific and very platform specific. So you must please inquire with your product provider to see what's going to be more efficient. And in fact, I would recommend that you put that exact question to them and you ask them to give you back a response in terms of the costs of doing either way. I mean, that's what they're there for. They're there to help you out. So don't you're not alone in this. Put that question to them and wait for their response. Can you get the Satrix top 50 inside a tax-free savings account? So just a point of correction. It's the Corshares top 50 ETF. And yes, you can get it inside a tax-free savings account, as well as outside, as you mentioned. If it's not available on your platform, either email us or email your platform. We'll chase up with them and make sure that ETF is available. It certainly qualifies. It certainly should be available. All right. I think we don't have any more questions. Again, I'll give it a few more minutes. It says, again, guys, apologies if I'm not clued up on Standard Bank. I don't represent Standard Bank online share trading. Question says, does the list that Standard Bank online share trading provide, is that the only opportunity or investment opportunities for tax-free savings? I'm not exactly sure what that list looks like. If that list doesn't include every single ETF, which is also a collective investment scheme on the JSE, then it's not a complete list. But Standard Bank might have some functionality that says, we're only going to give opportunity to invest in these 10 ETFs. And then that's an issue that you need to raise with Standard Bank Online. Certainly, these things should be open. From our perspective, it should be open architecture. You should be able to buy ETF alongside a ETF next to a Signy ETF. There shouldn't be preference to any product as an investor. If you are being channeled into very specific products, you should be kicking and screaming and saying, guys, I want access to the full list of ETFs available on the tax-free savings account. There's a question about beneficiary nomination. Does it form part of the estate and attract a state duty? I don't have the exact answer. In terms of how we've looked at it at a very high level, yes, it would form part of your estate. And you would have to typically nominate a beneficiary. Otherwise, we would have to default to a will. even in the instance, in any instance of death or whatever. But it would form part of one's personal estate, as far as we understand. Please don't construe that as tax advice. Please seek out appropriate tax advice. Tax is a very specialist area, so we know the high-level tax environment, but in terms of your personal circumstances, please pursue that appropriate advice. I think that's about it. We've still got a few people hanging online, so I'll, as I said, I'll give it a few more minutes, see if there are any more questions. But once again, a big thanks from the Corshares team for tuning in today. We will hopefully be doing a lot more of these webinars with the Standard Bank team. So thanks for joining, guys. If you have any questions for Corshares specifically, drop us an email, go to our website, info@corshares.coza. And if you have any questions for Standard Bank online share trading, please don't hesitate to drop them a question. That wraps it up for today then. See, we're getting a lot of sign-offs now, and people are generally leaving. So thanks again. Really appreciate you tuning in. And we'll chat again soon, hopefully.